Hi there, everyone, and welcome into this week's market update. Now, don't forget that any advice contained within this presentation is general only, so it isn't tailored to your particular circumstances. You need to decide for yourself what is appropriate to you. Okay, so we've seen another rally today on our market, despite a little bit of negativity overnight, or I'd say fairly flat session in the US overnight. But we're having a nice, strong bear market rally at the moment. At this point in time, guys, and I'll switch over the charts in a second, we're not seeing any real signs of a bottom here yet from a technical standpoint. Okay, so no double bottom, no inverse head and shoulders, no high peak, higher trough. That we're not really seeing that sign of a bottom. So we're calling this still a bear market rally, as many people out there are. There are a few people I feel it might be a little bit early in trying to call the bottom here. Okay, but yeah, good luck if they are right. Obviously, they'll do quite well out of it. But nonetheless, we do feel there could be a little bit more in this, but maybe nearing the top. Okay, so let's get across to some charts and have a quick look. So first up, the XJO finished a little bit stronger throughout the match and actually was able to get up to a new high for the day at 67.63. I'll just sort of scroll right out here first up just to put things into perspective. Okay, so you can see here we've had a huge rally after COVID. That went into a bit of a sideways phase, and we can clearly see now we're in a bear market sort of phase at the moment. We're fairly early into that bear market phase compared to the US markets, and this is a counter trend movement at the moment. We've kind of launched up. That's been a pretty decent move over the last week, and you can see here, we've made up about 5% of that recent 12% fall. So we're heading into about half of that fall already. Targets to the upside ones around 68, 68.50. The others after that, coming up near closer to the 7,000 level, or 69.70 thereabouts. There's heaps of levels up here that we could talk about. So if I kind of feel we're getting close to the top of this move, most of my indicators are suggesting the same. But if we don't get any negative news over the next few days, you could easily see this up near 7,000. That's a possibility. It's within the range of what this trend has been doing. Okay, so it's on the table. Is it probable? Maybe not in my mind. Is it doable? Yes. I'm not going to try and call the top of this move. Let's just see where that top is. And then we can trade from there. But basically, many people have gone long at the bottom here. We've gone long. We've got multiple bullish trades out to our clients at the moment, and just looking for an opportunity to close. And that opportunity comes when the resistance reveals itself. Okay, and that's how we're trading it at the moment. So look, in the short term, guys, the momentum's up. All right, I suspect that could continue up in through the next rest of this week, but there's definitely some headwinds coming for this market, and that major headwind for me would be looking at the inflation data. So you got PCE data coming in on Friday, and then after that you got the CPI reading coming in on the 13th of July. That's the big one. Okay, so there's definitely some headwinds coming, not to mention the GDP number Wednesday night could also affect the mood of the market. Now, coming across the S&P 500, we're basically looking at something quite similar, right? Huge pullback, about 12% in a matter of a week or so. Now seeing a bit of a retracement of that move back to the first key level here, second key level at 4,000. So I suspect one of these two will be resistance, and we'll see potentially this bear trend continue. So S&P 500, I think, is close to the top of this move. We might see just a little grind from here, and then the next catalyst to roll the market over. The market will come down with a little bit of force once again. As for targets to the bottom of this market, my first target's 3,500. That's the target created from this head and shoulders up here. It's also a key Fibonacci level, as well as the 200-week moving average that has proven to be an important level in this overall longer term uptrend. So for me, 3,500 is the level of levels. If that breaks and we come back up to use that as resistance, I'll be very technically bearish. If it comes down and tests it and continues to use it as support, and I start to see the reversal signals I'm looking for, I'll start calling the bottom. I'm not seeing the bottom at the moment. I would not be calling it even close. Look, I do think we're closer to the bottom than the top, that's for sure. But I'm not close to calling the bottom. I think it's going to take quite a few months for some kind of reversal or sideways pattern down here to play out before we're going to call this the bottom. Okay, so we're a ways off that, and there's too much going on out there, really, to be able to say confidently that we found the bottom at this point. All right, so I'd have to say the biggest thing that's changed in the past week or so is commodities. Okay, so we're seeing across the board a lot of infrastructure metals, so copper, aluminium, silver, um, all got hammered, right? Nickel down quite a bit more of a future metal at the moment. But a lot of these industrial commodities have been hammered. Agricultural commodities also hammered. Crude fell with this, but has lifted since. So, and left all the other commodities behind. Now, there's a little bit to read into this, guys, and I'm not sure in the tea leaves of what's going to come next. But there's a couple of scenarios, one very, very negative and one a little bit less negative, and one positive, right? So three scenarios I'll talk about here. I'll start off with the worst and we'll work up from there. Worst case scenario here, guys, is with the interest rates being lifted and people worrying about a recession, commodities could continue to fall. And what I'm talking about there is things like copper, iron ore, aluminium, those industrial type metals. Agricultural products could continue to fall. But crude stays higher. So if oil goes up from here, because we know we've got an energy problem because of the war with Ukraine and Russia and other issues that I won't sit here and talk about. But if crude continues to rise and these commodities continue to fall, it's a bad recipe for our exporters here in Australia. It means their costs to mine goes up because energy prices are going up, but what they're receiving for the end product is going down. Okay, so in the next few weeks, if we see this trend continue, this trend started the last couple of sessions. If that trend continues, miners will come back down. Okay, so worst case scenario at the moment, all right. Absolute worst case scenario, crude continues to go up, cost of diesel keeps going up, and then you see these commodity prices continue to fall because we're weakening demand by lifting interest rates and pretty much causing a recession. So that's the worst case scenario. The next, which is bad, but not bad for the miners, but not as bad, is crude and commodities fall. Everything falls together. That is the best case scenario for commodities going lower because you get the cost of energy, so the cost for the miners to produce goes down. But yes, they're going to take a hit on the commodity prices going down as well, but it's not as bad. That is a good case scenario. The better case scenario for the overall market. We want commodities lower. We want energy lower for the rest of the sector. So for discretionary to perform extremely well, or tech, for instance, in the US, we want to see also crude prices lower. And that takes the pressure off inflation. That gets then the sentiment back towards buying those discretionary stocks. So there's a few things to digest in all of this in watching the commodities market. All right. So, best case scenario, guys, absolute best case scenario is energy prices finally come off, and then things come back to normal. Copper a little bit up, industrial metals start rising again whilst energy continues to fall off. Don't think that's going to happen anytime soon, guys, but that would be the best bullish case scenario for our markets. So, look, commodities is the place to watch for a forward indicator of what's happening, especially crude in the energy space. If we can get crude back below $100, that's going to go a long way, a long way to supporting markets overall. Okay, so there's a dynamic shift out there that's happened. The commodities have sold off because of the risk of recession. They've sold off heavily because of the result of the Federal Reserve lifting rates by 0.75. If that rhetoric continues, I would suspect commodities will continue to fall off maybe a little bit more. So watch this space. The other thing we saw since the Fed announcement is strong buying in the bond space. So that's sent yields much, much lower. That's also a bit of a positive because it's resetting the expectations of where the RBA and the Fed's going to lift rates to. So the 1-year Australian bond has fallen from roughly 2.8 back down to about 2.4, suggesting that the RBA won't lift as far as what they were first expecting. If that 1-year rate continues to go down to 2, that's also going to keep resetting lower and lower and lower the expectation of how hard the RBA is going to go. So seeing the bond yields falling means strong buying in bonds, which means yields are coming down, and that's a positive thing for markets at the moment because things just got a little bit too overheated in that space. So it's this sort of funny double-edged sword scenario because the talk of recession is what's actually making this happen. Recessions are bad. Therefore, people are moving towards bonds. People are moving towards bonds. They're dropping the yields. It's resetting the expectations lower to where the RBA is likely to send rates. Keep in mind the RBA is only at 0.85. They're likely to go half a percent again next week, which will put them to about 1.35, with the 1-year bond market sitting at about 2.48 at the moment. So still a long way for the RBA to go to get to where the bond market's suggesting. Okay, but if the bond markets if the yields keep falling, well, hey, that just brings us more quickly to the point where interest rates will peak. Right, so there's a lot to think about and digest in all of that, right? And that's why the market is all over the place because to bring inflation down, they're lifting interest rates. Okay, lifting interest rates may not solve the problem. Okay, killing demand, yes, we're starting to see some pressure come off, but the main one that they need to fix is energy. If crude prices continue to elevate, they will not fix this inflation problem. So it's a battle between, really, in my mind, it's a battle between crude and the central banks at the moment. Okay, which one's going to win? Okay, that's the question. So has inflation topped? Okay, maybe. Okay, I dare say we're closer to the top than anything. I still think there could be a few months where we see some sketchy inflation data, especially if crude doesn't want to come off the boil. So we want to see crude down. If we see crude down, that's going to bring inflation down very, very quickly. Understand something here that, you know, as long as at least crude stays at $100, 110 in this range for the next 12 months, inflation will come down. We'll have found the top. If crude continues to lift, there's no way we found the top of inflation. Okay, so look, I think we're close to the top of inflation, but I still think there's a few months here where the market's going to see some fear on the back of inflation and lifting interest rates. I don't think it's all going to reset as quickly as what people are hoping. Okay. We saw the first sign of hopes when crude fell to about 105, but with it back up near 110, 111, I'm starting to become a bit of a skeptic again. But let's see what the next move is. Okay, if the next move is up, okay, well, you know, the expectations of finding the top won't be there. If crude comes back down, you know, it's easy to see the top from here. Then, okay, that's what's in the balance for me. So really, not much more to say right now, guys. Look, we've had a big reset since the last Fed meeting. Bond yields have come off. Commodities have come off. Crude needs to come off more. Now, it's really the market's setting themselves up for the next round of data. GDP tonight, price index data at the end of the week, PCE price index data, that would be Thursday night. Then the big one, like I said earlier, the 13th of July CPI reading, then the Fed at the end of July. They're the big announcements that we're looking for, so that's going to really rock the markets. The next big thing also outside of that would be a couple of weeks from now, we'll see US reporting. And through that, we're going to see some big winners or losers of what's happened in the last quarter. I'd suspect we're going to hear a lot of noise around cost blowouts, especially, you know, really across the board, guys. There's not many companies that can hire from higher energy prices. Okay, so there's going to be cost blowouts across the board. It's all going to come down to what these companies want to put out as forward guidance. I would probably think we're going to see some negative forward guidance at this point of time. It just comes down to whether it's more negative than what most people are expecting or not, funny enough, right? So we're expecting guidance to be low, but that could already be cooked into the market. And that's where reporting seasons are so important to grab a snapshot of what the sentiment is and what people are thinking. Okay, so very important period of time through July into August, and we'll have to see what the wash up is then. I do feel by maybe September, October, we might have seen the bottom of most of this, okay, from the inflation side. And it's just going to be the matter of how the market wants to react from there to the midterms in the US. So, there's still a lot to come this year, guys. I think we're still going to see a fairly volatile year, but I suspect we'll find a bottom at some point this year and start pushing up into next year. Central banks will find a level where they'll stop lifting interest rates and maybe, depending on how bad this recession will get, uh, could slip in the word stimulus again. Who knows, right? I don't think it's going to take too long for them to find the top of interest rates. Can't see them lifting rates right through to the middle of next year, like some people have been suggesting. I think this will be pretty short and sweet. Back up near that 2.5, and that will be about it, guys. Really, I think that's where they'll stop. All right, so that's a prediction at this point, and that prediction will change depending on what happens next, right? So, look, I hope you enjoyed this video today. Take care, everyone, and bye for now.